Stifel Financial.
My name is Chad Morganlander. I'm with Washington Crossing Advisors.
And Mike Batestelli with Stifel Nicolas here in town.
Okay.
All right, well, we're going to get started just by having you open to page 1 there in your booklet, if you would, with the pie chart in your bottom left-hand corner. Chad's here. We're going to give him as much time. We always kind of say that we want to give him as much time as possible to be able to speak, so we'll kind of go, I don't want to rush through this at all, but we want to kind of go through where you're at for the year. And this is through the first quarter, so this is through March 31st. And underneath the bar chart there, you'll see the combined portfolio, which is the different managers that we have utilized, just showing their performance for the year. So for the quarter, it's down 1.59%. Of course, the year to date is the same, 1.59%. Then the 1 year number, which would go back 12 months, obviously is 5.82% positive. 3 year period is 4.42, and then the inception number that goes back a number of years, quite a number of years, is a 5.82. And then moving to the right of that, over underneath the line chart, just to kind of like to give an update with that, the quarterly number there, if you see the quarter started, which would have been January 1st at $125,021,223. Underneath that column of 2.2 million is the withdrawals during the first quarter of the year, and underneath that is in this case, the depreciation, the negative 1.945 million is actually what we had in the way of depreciation in the portfolio, leaving us at the end of the quarter at $120,817,664. Column to the right of that, the 1 year number, again just showing the withdrawals of 5.3 million, again underneath that. Appreciation of 6.9 million, again that's just over the last 12-month period, so that would be April 1st of 17 through March 31st of 2018. Any questions on that at all? Okay. One other thing I'll just point out real quick is the bottom left-hand corner is the pie chart area, just an allocation per the investment policy statement. We always try to stay in that. It's just showing your equities there at 66.28%, your bonds, your fixed income at 30.2%, and then cash is represented at 3.52%. We always mention, because this report does not break out that REIT portfolio, we always like to mention that makes up 5.39%. So a little over 5% is in the real estate investment trusts, which brings your equity closer down to where the investment policy would have it at 60.89%. What that is. One other thing that we mentioned, just due to time, won't get into it again, but we always talk about the different risk analysis that we're looking at. It's something that Mike and I look at on a very, very regular basis. It's one thing to get performance, but we want to get smart performance, if you will. We don't want to take on undue risk. And there's different risk analysis, like Sharpe ratio and things like that, that we try to look at. And the portfolio has actually moved in a better position here in the last 3 to 6 month period. I think we're in a better position from that standpoint too. So those numbers are appropriate, what we would deem as appropriate. And then Mike has up-to-date numbers if there's no questions on any of that at all.
So I'll just give you, as Brett said, the up-to-date numbers. This is through yesterday. The portfolio balance was $123,931,024. Performance now, of course unaudited, but as best we can get, is it's down 0.36%, so we're getting closer to that even mark. I will point out that now year-to-date withdrawals, pure withdrawals, is $2,959,000. And on May 15th, the county, we did get the check for the ARC payment. That was $2,598,990. So that money did come in.
I was going to mention that's paid out of the controller. I requested that, so.
Okay. I didn't steal your thunder, did I?
No.
Okay.
No thunder.
So it's an expectation now.
Right.
We do it now.
Yeah. And then the asset allocation, the only thing that's really changed there a little bit, what we did do with the ARC payment, we did this last year, is we just have it in a cash account to kind of cover the next few months of cash needs on a monthly basis to pay the pensionees off. And we'll probably continue to do that. We've had some volatility in the market, so we think it's better just to kind of keep it in cash for now, because we know we're going to need that money in the near term. That way we won't have to lean on our managers to go in and liquidate or make cash available.
Okay, so you just turn that around.
Right, yeah. Yeah. Get credit, obviously, for putting it into the
Right,
pension plan.
yeah.
Yeah, yeah. Any questions on that, on the update?
No?
One before we okay?
Your question?
No.
Before we turn it over to Chad, one piece of, I guess, old business from the previous meeting, quarterly review that we were in, we had touched on possibly adding a global equity strategy to the portfolio. And before I dive into that, I guess maybe it's better to maybe get a feel for the pension board, you know, whether you're interested in that, if there's been more discussion, more conversation about that.
I personally am comfortable with what we have now. It's just my view.
I was more interested in your recommendation following that. Yes, I'm open to the global.
I'd certainly be open to looking at it.
Okay. I think maybe rather than get into too deep into the details, if we were to go forward with that strategy, we would be just dipping our toes into it. We're talking about potentially $3 million, which would be about 2.5% of the portfolio. Understanding that it is a new concept to this board, we've kind of stayed away from foreign stocks. That's kind of what we would be looking at least to get started. And I don't know if you want to just pass these out. I don't necessarily know we need to make a decision. This isn't an imminent decision that we have to do today, so maybe with that in mind, we'll just share a little information.
Maybe we could do a workshop some Wednesday afternoon.
Yeah, that would be-
Yeah, we'd
that
be happy to
might
come
be
back
good.
and have more
Yeah.
conversation.
Yeah,
But
probably work better.
the particular strategy that we're handing out here is it's a group, it's a global equity strategy through the Capital Group, which the parent company is American Funds. This is a separately managed account. And currently in there, just highlight a couple things. Currently in their portfolio, they have 53% of their assets in U.S. or Canadian companies, 32% in Europe, and 10% in Asia or Pacific companies, or countries rather. So a lot of that, half of that portfolio is here in the North America. And it's averaged about 7.84% over the last 10 years. And we can get into the details. We look at alpha, and it's got a pretty good alpha number, and so on. But I think maybe that suggestion there, coming back for a work session, and we can dig a little deeper and find out if there's concerns. Joanne's kind of said maybe she has some concerns about it, but what are the benefits or potential drawbacks of doing that?
Yeah, I think that's a good idea. You'd be willing to do that, Commissioner? Take a look at it.
Well, if they can come, I don't mind.
Okay.
They're always welcome.
Okay,
All right, I guess it's my turn.
you're up.
All right. So my name is Chad Morganlander. I work at Washington Crossing Advisors. Normally my partner Kevin Karan has attended these meetings as well. What I'd like to do is give you a brief description of the portfolio that we're managing on your behalf, and then have a segue into how we're looking at the financial world at this point in time, and take you around the world, not only domestic, but also on the international front, developed as well as emerging, and also talk about interest rates as well as monetary policy, because we think that that all feeds into the bigger picture of what we're talking about today, which is the $100 million portfolio that the gentlemen are managing on your behalf. So Washington Crossing Advisors currently manages about $2.3 billion, and we have a equity sleeve that we manage for you. The equity sleeve is called the Victory Portfolio. So let's take a step back and talk about the portfolio that we're managing for this team. The portfolio is an all-cap value portfolio, primarily focused on U.S. domestic securities. From time to time, we may buy an ADR of a big multinational corporation that may be domiciled out of the United States. But overall, 90+% or to 95% of the equities we're buying are domestic. The portfolio has some critical principles that we should focus on because it makes us very different than other portfolio managers that may be in your portfolio currently. We like companies that are consistently growing, consistently profitable, and they can't have a lot of debt on their balance sheet. Therein lies the subtlety here. Because we're focused on balance sheets of companies that don't over-leverage themselves, then you're getting a group of companies that will shy away from financials as a sector, or companies or sectors that use leverage to enhance their business functions. The other key contributor of this type of methodology is that the companies that we're buying have to be diversified. They have to have a diversified client base as well as a diversified product line. The businesses have to be quite simple and somewhat boring. So this is a methodology that you're not going to brag about at a cocktail party. But nonetheless, the companies that we're buying, their intrinsic value and the free cash flow of these individual entities will continue to move higher, even in a recessionary time period. So for example, year after year, free cash flow from the corporations will continue to incrementally accrete in value. The intrinsic value of those corporations, take for example, a company like Hormel, which you own in your portfolio, the intrinsic value of that company will continue to grow. The stock price may vary based off of the market conditions and the way that the stock market behaves, but the individual entity, the corporation, will continue to actually, in a stair-step manner, increase in value. We think that overall, if you populate a portfolio of companies like that, boring, consistently growing, consistently profitable companies that are reinvesting back into their business, then you will do quite well over a longer period of time with much less volatility than the overall financial markets. There is another component to this strategy. Because it was built on a sound principle of being conservative, if we cannot find things to buy, if we cannot find companies to buy, we would rather keep the money in cash than deploy it and utilize it. So because of our strict investment philosophy and our guardrails, we would rather defer to cash than to actually do something silly or perhaps haphazardly go investing in the market to try to beat the benchmark. We're not trying to chase a benchmark. That's not one of our principles. We're just trying to buy good quality companies. Lastly, if someone asked me, well, in 90 seconds or less, how do you sum up your methodology? I would say it would be simple, clear, easy to understand from every company that we're buying. If I cannot explain this to my daughter who's 13, the individual companies, or my son who's 16, in 90 seconds or less, and they don't fully understand the company that we're buying, then we have no business being in those companies. So, we do have cash in the portfolio currently. It's a little bit on the higher end. It's roughly about 20+%. And that is because of our investment philosophy, we cannot find things at this point in time. We do have a laundry list of companies that we're looking at, and as the markets fluctuate, we'll start cherry picking the best ones that we think are positive, will give us a positive return over the long run. Critical word I just used was long run. So let's talk about that definition of long run to our group. Long run for us means 5, 7, and 10 years, not 5 minutes, 7 minutes, or 10 minutes. There are a lot of people out there that are investors that consider themselves long-term investors. But yet, when the markets start to fluctuate or their company goes out of favor, even if the company is improving from an intrinsic value perspective, they will head for the hills and sell the company, which is a bad idea. We would like to hold those companies in favorable times and unfavorable times. When the stock prices are going lower, we would prefer to buy them at that price, as long as the intrinsic value of the company continues to glide higher. So that is the simple Washington Crossing Victory portfolio. It's a sturdy portfolio. I think that it's an honest methodology for investing in good quality companies with not a lot of hocus pocus.
Sounds like Warren Buffett could work for you.
It's a similar philosophy about compounding of the money, and I don't mean compounding from an investor's perspective, but the companies that you're buying, their operations, the revenues are going higher, the cash flow is growing, and you'd be surprised on cash flow that is $1 billion, and all of a sudden you wake up 5 years later and it's a lot more than $1 billion. And that is where, as long as they're reinvesting back into their company and they're getting a higher return on that invested capital, that's a beautiful type of kind of company that we're looking at. And I think a good way to look at it is, I know it's a boring company, but familiar with Spam, Hormel, right?
That was one of my questions. Did I hear Hormel as in Spam?
Not Amazon. You didn't hear Amazon, nor did you hear Google and Apple. And people roll their eyes and they say, boy, why are you talking about Hormel? That's the least sexiest story ever. And the reason is because they only have roughly $300 million in debt. I may get this wrong a little bit, $15 billion market cap. Company's been around for over 80 years. And the dividend has grown over for the last 25 plus years. And they're expanding. They're expanding, they're buying companies, paying down their debt. Way after they buy it, they run the company the way that you and I should run our finances at home. Meaning, don't have a large mortgage, pay for things when you have the money, not go on and use your credit card. And they're expanding their margins also because of the operations that the products that they're buying, more packaged food, more consistent, higher profit margins. Those are the type of companies we're buying. Some of the times they're going to come in favor. They're going to go in favor and out of favor, and we're going to underperform from time to time. But I think over the long run, the volatility will be substantially less, and you'll be able to sleep at night.
Okay, any further questions?
Yes. Now that I'm sure I heard Hormel, I do have a question. With the bell curve, you said how long they're in business. What do you see as their peak, and when will they start to fall? In other words, how long of a lifespan do we have with Hormel? And that's question number one. Number two is, convince me that we're better off letting you hold our cash than letting these guys hold our cash, and then having to pay, I'm thinking, double dividends or fees or whatever for the two of you to hold that cash. And are we ending up with more money in the end? Does my question make sense?
Well, first, Hormel, we look at each company and look at their operations, and as long as they're expanding, growing profitable, and continue to be well capitalized, and the key word there is, to answer your point, is Hormel, yes, is growing. Yes, margins are expanding and improving
Are
over
they
the long
selling
run.
in the United States or overseas? Where is their market these days?
Spam. Hormel is over the United States predominantly, but 80% of their revenues are from the United States.
Really?
Yeah, and then they can go internationally. So this is a good quality company. It's an example of the type of companies that we have in the portfolio. We use cash as an asset to buffer against volatility. So there are times that we've been here over the last 12 months that we've had over 90% in cash, 90% in stocks rather, in equities. So it's not as if we're sitting on our laurels and keeping it in cash and not utilizing it. Important to that is the cash market is now, interest rates are starting to go high, a bit higher. So you're currently, the yield on the Fed funds rate is about 175, and we'll go into that in the next segment of this conversation that we're all having. But we use it as a cash buffer to then go back in and actually, when there's seams of opportunities, because we have a laundry list of companies to buy, we'll go and we'll purchase, and we'll roll it into more risk. So we're optimizing the portfolio. And what you'll notice is that if you looked at our strategy over the last 15 years, the volatility has been substantially less than the S&P 500, and the returns have been pretty good, pretty sturdy, quite sturdy. So I'm pleased with the returns, with, more importantly, the volatility of the portfolio is not like a roller coaster. It has been much less than a roller coaster over the longer period of time.
And Chad, if I could just
Sure.
interject, that's the whole, all the managers put together, we definitely have more of a value slant to it, more of a conservative slant to reduce the amount of volatility. So these folks fit that mandate almost perfectly. Regarding, I think your question regarding fees, there's no double fees or anything like that. So it's all part of the overall fee structure. So if they feel like they can't find something of value in the way that they manage their piece of the pension, we're very comfortable with them keeping cash. We don't want them to step out to where they're uncomfortable, get out over their skis, as some folks refer to that. They're very comfortable with the way they manage money, and if part of that is keeping cash from time to time, we're very comfortable with that.
Particular question.
Okay. All right. Very
So
good.
if it's okay, I just want to touch upon the global system for a second, if you don't mind, if I could have 5 to 10 minutes.
Are you guys okay with that
Are you
time,
okay?
or are you
5
still
minutes?
pressed?
5 minutes.
How about I give you 5 minutes?